Hello, hello. All right. It's probably the most sober any of you motherfuckers are going to be for the rest of the week. All right, so are we there yet? So when I was a kid, I remember driving in the car. I fucking hate car rides. From Buffalo to Detroit and back and forth. It's about a 5-hour car ride, and you always invariably ask your parents, like, are we there yet, right? You're checking the clock, you're bored out of your fucking mind. We didn't have TikTok back then. So are we there yet? And what am I actually talking about? The thing that everybody in this room really cares about. You know, you open up your MetaMask, and you've got that piece of dog shit coin that you bought in 2021 in November, and you're like, oh, fuck, when's it going to get back up there? Like, that Sol at $200, Bitcoin at 70,000, ETH at 4,800, whatever. You guys all know the things you don't want to talk about that's in your portfolio, that you want to just get back up to where it was at the end of 2021. And so, essentially, we've been in this sort of, waiting game. Like, okay, we bought them last year when, the FTX debacle, 15,000 in Bitcoin and like 700 on ETH or whatever it was. And, we're up somewhere double or 80% of whatever it is on a lot of these things. And we're like, okay, well, where's the bull market? When's it coming back? When the fuck is it party time again? When are all these companies going to stop going bankrupt and actually make some fucking money? And so that's sort of the title of this talk, and it's obviously macro because it's what I'm passionate about. So we'll have some chart porn for you guys and have a little discussion of Fed interest rate policy. All right, so I'm a bit of a Bitcoin maxi, but not really. I trade a lot of shit coins as well. But again, I'll bring it up to the Bitcoin level because I think it's informative for the rest of the complex. So what is Bitcoin? And I've said this many times in many presentations and essays. It's fiat liquidity, right? And it's technology. Now, obviously, we're very passionate about the technology, decentralization, peer-to-peer cash, blah, 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 right? Unfortunately, it's very, very hard to value that technology. You only really value it until you are experiencing a situation where you don't have that, right? So imagine if you're somebody who all of a sudden loses access to their bank account or can't trade anymore, and you're like, oh, fuck, now I get what these Bitcoin idiots are talking about, how I have a financial system that's not dependent on some bank or some, insurance company or whatever saying, yes, you can access your financial wealth. That's the technology aspect. It's a very personal thing. Everybody has a different value for it. It's very hard to quantify. It's hard to predict when the market is going to value the technology that is Bitcoin and a lot of the things that people in this room are building. But what we can have a lot of confidence in by looking at economic cycles is the fiat liquidity part, right? We're in this fiat regime, a global monetary regime that's backed by nothing than the word of a government or a central bank saying, please trust me, I'm going to do what's necessary to maintain the purchasing power of this piece of paper that you hold in your wallet, probably now in your digital wallet. And there's many, many economists and thinkers and traders who spend all day, all night thinking about the global credit cycle and what that means. Is there more or less money floating in the system? Do the assets that are in my portfolio, are they going to perform well if there is more or less money in the system? And obviously, Bitcoin is a reaction to, almost, 80 years of Keynesian economic policy of just printing money to do stuff, which, started in 2008, obviously at the start of the global financial crisis. And so we have this very real part of the equation of what we value Bitcoin as is what's the denominator of fiat stuff that's being pumped out into the world. And because central banks and governments and companies publish statistics on, how much credit they're allocating, global money supply, we can, form a very informed opinion about what the future of that is. So I'm going to spend, obviously, the most of this presentation on the fiat liquidity part of the equation. Right. So I believe that this current bull market started on the 10th of March, 2023. And for those of you who don't know what this date means, it's the Friday before Silicon Valley Bank and Signature Bank were taken over by the FDIC in the US. Obviously, the week before, Silvergate had gone into bankruptcy. And this is, Bitcoin was trading around 20,000 that weekend, and everyone's like, oh, fuck, right? Are the tech bros and the crypto bros going to lose all their deposits in these two very important banks? And so over the weekend, everyone was like, okay, will they or won't they roll out some sort of bailout package? because the Fed had been talking big, Federal Reserve that is, had been talking big about, okay, we're going to reduce the amount of money in the system, we're going to raise interest rates, we're going to tighten monetary conditions, and so bailing out two banks, bailing out the depositors of two banks that were heavily into speculative crypto and speculative technology probably isn't the thing that the Fed wants to do to engender this belief that they actually care about the purchasing power of a dollar. Now, obviously, on the Sunday night, across my Bloomberg screen, Fed and the Treasury have agreed to, they called it the Bank Term Funding Program, BTFD, or by the fucking dip, right? And you should have done it. As we stand here right now, Bitcoin's up about 35% since that date. And why I say that the bull market really started on that date, it's because it's just another example of the leading central bank, and I'm going to spend most of the time talking about the Fed, even though we're sitting here in South Korea. Every other global central bank follows what the Fed does. I don't care if you're a communist nation like China or you're a capitalist nation like the United States or Korea or whatever, right? We're all intertwined in this global system. The dollar sits at the apex. What the Fed does influences what every other central bank does. So I spend most of my time talking about the Fed and the American economic and political situation because everywhere else is just a derivative of that. And so if we focus there, we can make some informed guesses about what's going to happen around the rest of the world. Right, so the 12th of March or whatever, they roll out this program, and I think I penned an essay the next week basically saying that this was, unlimited money printing in a different name. Because essentially what they did was they backstopped the entire banking system by saying, please give me your underwater dog shit bonds and I'll give you fresh dollars. They'll charge you a rate for it, but again, I can tender what's on my portfolio and I can get dollars to solve my funding crisis. And I can do it in an unlimited quantity. And so me and the rest of the market, I think, rightly saw through this as basically them admitting that they've caused this problem, the structure of the banking system, and this is one of the ways they can fix it, which is print more money. And Bitcoin is up. You can take a look. Tech stocks are up since that day. Gold has been up since that day. So this is when I believe that the bull market started. We have basically ditched this whole facade that we care about the value of the dollar or the value of any fiat currency, and we've admitted that, okay, when shit really fucks up in the banking system, we're going to print more money. Now, obviously, ever since probably the 1970s, 1980s, we as investors have been heavily trained into how to respond to injections of liquidity. Now, this is a chart that I like to post a lot. Now, the white line is the Federal Reserve balance sheet, and the yellow line is Bitcoin, and I've indexed them to 100, starting in March 2020. That was obviously a very wild month, COVID month. Bitcoin went down 50%, then rallied. S&P was crashing. 10-year Treasury hit 33 basis points intraday. And then, again, more money printing came about. And what has been the return since then? Bitcoin has outperformed essentially the global leading central bank by 137%, right? So it has done well over and above the amount of fiat that has been sloshing around in the world, which leads everyone to think, okay, well, if the global central banks are printing money, then I should own Bitcoin or some other assets that have a fixed supply because the denominator is expanding in an infinite fashion, and therefore I should make more money, right? And so the follow-on to that is, okay, every time I think that they're going to loosen financial conditions, I should go long stuff like Bitcoin. And we're like, okay, and so now we're in a bear market, so we're kind of thinking, okay, so when is the Fed going to switch? When are they going to do another March 2020, a March 2023, turn the taps back on, Bitcoin goes moon, everybody's rich, everybody's happy again, Lambos, blah, 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 right? That's what we're all thinking. We're all trained to do this. And so we're all looking for when are they going to cut? When are they going to cut? When are they going to cut? And every market analyst is saying, when are they going to cut? When are they going to cut? They'll point out this economic indicator, that economic indicator. Everybody in the entire industry of managing money globally is focused on when is the Fed going to cut rates, and can we focus on some particular economic variable that we believe leads their actions to printing more money so that our portfolio goes up in value, right? So we're trained to think this way because that's how it's been done for the past 30 or 40 years. However, and so I've argued this, I've written so many fucking essays about Fed policy and this and that economic indicators say that the US is fucked, therefore they're gonna print money. So I was like, well, I want to give a more interesting presentation than just presenting the same thing I've said 15,000 times. So I asked myself this question, I was like, well, how about I take the other side of the argument and try to stress test my portfolio and say, what if I'm wrong? What if there is no Fed rate cut? What if there's no rate cut at the ECB, European Central Bank? No rate cut at the Bank of Korea, no rate cut at the RBA. The central banks just keep raising rates because inflation is sticky or is now on the upswing due to energy prices. What if there's no US recession, or a global recession for that matter, that everything's just fine, we've solved the economy, we've printed our way back into prosperity? What if inflation doesn't fall? I'm sure you've been reading, if you're attuned to financial media, everybody's talking about inflation is over, the global central banks have killed it, it's going down, it's going to stay down, it's going to go back down to 0%, and therefore they should start stimulating by printing money. That's what we all want them to do. What if there's no financial system meltdown? Obviously, I've been talking a lot about different strains in the global banking system that could cause the Fed and other central banks to rush to print money to save the real constituency that they only care about, which is the fiat banking system. And so therefore, if any of these what-ifs actually happen, then there are no rate cuts. What does that actually mean for my portfolio? Am I deluding myself by being long all this crypto and continuing to buy dips as they occur to thinking that in 12 to 24 months' time, because all of these things, this bad stuff's going to happen, Fed's going to print more money and then Bitcoin's going to outperform again like it did in the last cycle. Now, obviously, TLDR, I think that will still do well, but I wanted to explore this and see what happens if we take the other side of the argument and say that, okay, well, the Fed just continues raising rates. What actually happens at a very high macroeconomic level? So the first thing that I think about is real interest rates. And I define real interest rates as the government bond yield, and wherever you are based, minus nominal GDP growth, right? And so I don't want to get into GDP deflators and real, what's the actual real inflation rate, because every government manipulates what they tell you is the inflation rate because they don't want you to be pissed off, because inflation pisses off 100% of the electorate. So you better manage this feature of the economy, or else you will be out of power, and there's very many examples of regimes that have fallen due to rampant inflation amongst the people. So real yields are how much is the economy growing for all the money that we're pumping into it. Now, if the government bond yields are above the growth in actual economy, then it's restrictive, right? Because if I'm borrowing money, my business or my venture needs to be that much better than just the average growth rate of the economy where I am to pay back my loan. So I better have a very, very good idea or a very profitable future deployment of this capital. Now, I argue that this is the real rate, not some Treasury inflation-protected security or some other manipulated government bond statistic. But real rates across the curve are negative. And again, we're going to focus on the US for this presentation. So I did a very crude graph. So this is the US 2-year note. The reason why I used the 2-year note is if for those of you who have Bloomberg, if you go Treasury active curves, you take a look at the US Treasury yield curve, you'll see that it's kind of like a spike at the top, and that's the 2-year yield. Probably the 6-month point is the highest yield, and the 2-year is probably the most traded instrument to gauge where short-term rates are. And the 2-year yield has spiked heavily. It's around, I think, 490 basis points when I checked this morning, something around there. So it's one of the highest points on the curve, right? And I took a look at, this is backwards, but the US nominal GDP growth, just from Bloomberg, and I graphed it. And if you take a look here, it's been quite negative since the Fed has started hiking in March of 2022, and we've recently went barely positive in the last quarter. So if you think about what's happened since the Fed, this is where the Fed started, they had a problem. Real rates were very, very negative. They tried to do something about it, raising rates at the fastest clip in modern US economic history, and yet we're barely above zero on the only bond that has a very, very high yield. If you took a look at the 10-year yield or the 30-year yield, this chart will be purely negative since March of 2022. So then I thought, okay, well, that's the past. We don't care about the past. The past has been priced into the market. What's the future? So the Federal Reserve of Atlanta published this thing called Nowcast, and they try to estimate what is the current real GDP rate given all the data that we have currently, right? And so for third quarter of 2023, I took this data from, I think, Sunday is when I made this chart. The Atlanta Fed Nowcast GDP was positive 5.6%. That's fucking massive, right? That's like China kind of GDP, and this is the largest economy in the world. Then I made up a bit of a fudge here, 3.7% of real GDP deflator. I basically just took the difference between real and nominal for the past 5 quarters and just averaged them out, being a bit lazy here. So we get a sort of a 9.3% nominal GDP growth estimate for the third quarter of 2023. So put a plus or minus 2% on that of an error rate. It's still fucking huge for, you know, the trillions of dollars that the U.S. economy represents. And so then when we take a look at, you know, the 2-year yield as of this weekend, 4.9%, minus this nominal GDP, we get a minus 4.4%. So what the fuck is happening here? The Fed has raised rates and briefly got them real rates positive at the 2-year bucket, and then all of a sudden, the U.S. economy is accelerating, and real rates are going negative again, because this shouldn't happen. If I'm restricting credit growth in a highly credit-dependent economy, I shouldn't be growing at 9.3% GDP growth. So what's going on? So we have to take a look at how the U.S. government funds itself. Now, a big thing in America is capital gains taxes, right? It's a very America exports finance. And so rich people make money on capital gains, they pay a lot of taxes on them. So if you take a look at this chart, and I didn't put the index here because it doesn't really matter. So I basically took from the start of 2022 till today, indexed at 100. I took a look at the S&P 500, the NASDAQ 100, Russell 2000, and then the Bloomberg US Global Aggregate Bond Index, total returns. I said, well, has anybody made any money since 2021? And the answer is no. So obviously, everyone paid a fuck ton of taxes for 2021 bull market returns, and then after the Fed started raising rates, everything fucking shit the bed. Nobody's making any money. Nobody's paying capital gains taxes. And capital gains taxes estimated, I think, 2021 represented about 8.7% of GDP. So it's a big fucking amount of money that is not being paid into the government coffers because the Fed is busy fighting inflation. And so what does that mean? US is running massive deficits. And this is the US deficit as a percentage of nominal GDP, and it's something around 8% here. You see it goes super, super negative for COVID, right? They had the different stimulus checks. Now, if we take a look at US versus every other major developed country in the world, the US stimulated their economy to essentially lock everybody in their homes for the lockdowns for COVID more than any other country in the world, which is why we saw this humongous boom of capital that went into Robinhood accounts, to NFTs, to crypto, all this stuff. Everybody did a variant of that, just not as big as the US, and they ran these massive deficits, biggest deficits since World War II ran in the US. But after sort of peaking at like -4, we're back down again. There's no more money. They need to print more money, spend more money to keep the economy afloat, and they're losing revenue because the one arm of the government, the Fed, that is raising interest rates is causing all these rich people not to pay taxes. Now, what happens when the government runs a deficit? Then the other arm of the government, the US Treasury, has to borrow money, right? And so they're borrowing records amount of money. By the end of this year, the US Treasury still has to issue $1.85 trillion worth of debt that has to be funded and bought by the global marketplace. What does that mean? I'm increasing the amount of debt that I have to, number one, repay and roll over, and issue to fund record government deficits. At the same time, the other arm of the US government, the Fed, is raising rates. So what does that mean? That means the US Treasury is giving out, close to annualized that last quarter, $1 trillion a year in interest payments. Now, the majority of people who own treasury bonds are wealthy savers on an individual level, right? So you park your money in your money market fund or some sort of bond fund if you're not an American, and you essentially are earning 5.5%, 6%. And it keeps creeping higher as the Fed keeps raising rates because they're trying to be restrictive on interest rate policy. So what happens when a wealthy person receives more stimulus in the form of interest, right? They didn't do anything. You just put your money in the bank and boom, every day it just keeps accruing. Great. They go out and they spend money, right? So this is an anecdotal chart. It's 1 in 5 Americans say they plan to travel abroad sometime in the near future. I was in Europe this summer. There are a lot of fucking Americans around, right? It's people are going out. They're spending money. They're spending money on services. It's one reason why it's confounding that crude oil demand in the U.S. is skyrocketing because people are traveling. They're out. They're doing things. People are going to restaurants. They're going everywhere. And people are spending money because every day, tick, 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 I'm getting paid by the Fed, by the U.S. Treasury, more than I've ever gotten paid in the last 25 years in terms of interest, and the amount continues to grow. So then I thought, okay, well, let's put this all together, right? And we'll step through this in a bit. So again, the Fed has to fight inflation. The U.S. president sat Jerome Powell down in the Oval Office a few years ago, and he said, "You're going to fight inflation." Jerome Powell said, yeah, I'm going to do that. And so they've been raising rates. Every single meeting, Powell starts off, we are aimed to get growth to 2%, right? 2%, 2%, 2%, and inflation is still 3.5%, 4% on core inflation. We are not done yet. And he keeps saying this message over and over and over again. So they're reducing their balance sheet, quantitative tightening by letting bonds in their balance sheet mature, and they're raising rates because they need to fight inflation. Because again, inflation impacts 100% of the electorate. If you are a president and there is inflation, you are not getting reelected. So therefore, you care about this. But financial prices fall. I showed that chart earlier that showed that since 2021, end of 2021, once the Fed started raising rates, nobody's made any money. Everything's down. Financial assets go down, capital gains taxes go down, government has less revenue. However, the government is still spending money. Now, in the case of the US, I don't know how it is in Korea and other places, the biggest contributors to expenses are healthcare and defense spending. You are not going to win a re-election as a politician if you go out and you tell old people that you're going to cut their health care. You are not going to win a re-election in a country that is geared to sell weapons if you come out and saying, I am not going to spend money on defense. It's just not going to happen. So these entitlement spending in defense are almost, you can't cut them. And so because there's such large parts of the budget and you have an aging population, you're only going to spend more and more and more on this. So you're spending more money, yet the thing that drove the revenue side of the equation, which is rising asset prices, is faltering because you've told the Federal Reserve that they need to fight inflation, and they're doing it by jacking rates, and financial assets, certain financial assets, are not performing. So what happens? You have big deficits, and you have big deficits as far out as the eye can see, which again adds to nominal GDP growth. Because when the government spends money, people have jobs based on that spending, and then they go and spend money themselves. So the more money you spend as a government, the more you're stimulating growth. That's the whole Keynesian prescriptive for an ailing economy. So if you have higher deficits, the US Treasury has to issue more bonds. I showed a chart earlier. What happens when you issue more bonds? You pay more money in interest, right? What do you do when you pay more money in interest? Rich people get more income. What do they do with the income? They spend on services. The U.S. economy, services represent about 80%, 77% of U.S. GDP is services. Who spends the most on services? People who are bored out of their mind with money in their bank account, right? They go out and they spend stuff. Again, increases nominal GDP growth. And so when nominal GDP growth is consistently above the government bond yields, inflation isn't going anywhere. Goods prices have to go up, right? And then what happens if good prices go up? Well, the Fed has to fight inflation, so they got to keep raising rates. So you have this circle, this vicious circle for the Fed of, okay, well, we have to be restrictive, but the mere act of raising rates makes us have to raise rates more. And so you have these negative real rates. And so it requires a change in our thinking. So if by fighting inflation, the Fed raises rates and it increases economic growth, and rates are negative across the curve, why do I want to own things that don't have a finite supply? I have a negative real interest rate. I need to do something to preserve my purchasing power. That's the whole point of Bitcoin, right? However, this is completely different than how we've not been taught, but been taught by the market to think of, okay, if interest rates go up, Bitcoin must go down. And we've been thinking this way. And it's not Bitcoin, you could replace that with S&P 500, with property prices, with whatever, right? And as this continues to tick along in the background, as we move out on this curve of just craziness and debt to GDP numbers and the amount of money that's being printed by just handing interest payments to rich people, what's going to happen in the market is not going to be what we thought is going to happen. And the playbook is going to change. It's going to happen slowly. This is my prediction, obviously. That people's mindset is going to start to change. Hold on. If rates are at 5-6%, why is Bitcoin still 25,000? Why is it not below 20, 15, right? What some people are calling, like going back down to where it was during the FTX. I thought that if the Fed's going to be super restrictive in raising rates at the fastest pace since the 1980s, that a speculative financial asset like Bitcoin should get absolutely clobbered. Why is gold still trading at 1950? Why isn't it down at like 1600, 1500? Again, rates are going up. These things should be going down in price. But when you move out on the absurdity of massive government deficits above 100%, the nonlinearity of interest payments and debt growth changes what happens when you start raising rates. And I've argued in a past essay that the Fed is actually printing money by the fact that the more money they hand out to savers and investors in these things like the reverse repo and treasury bonds dwarfs any amount of bonds that they're letting mature on our portfolio, and that this is actually stimulative to the economy and generally to financial asset prices. So it's all about a mental shift, right? We see what's happening. It's different than what's happened before. The standard playbook is starting to break down. So the challenge then is, well, okay, I'm seeing this. The market isn't responding yet, but give it 6 to 12 months, and let's say that the rates are at 7-8% because inflation hasn't come down, and yet US economy is running 9, 10, 11% nominal GDP. Why the fuck do I have money sitting in low-yielding bank deposits? Why do I have money in stocks that are credit dependent? Like the majority of the stock market, apart from NVIDIA, Facebook, Google, Microsoft, these are companies that need the banking system. These are companies that need credit. The Fed is restricting credit. Obviously, AI companies and crypto things, we don't need the banking system. The whole fucking point is we don't want the banking system that's being choked with all of this debt that continues to rise because the Fed has to fight inflation. So the bull market started on 10th of March, 2023. Yeah, Bitcoin could trade down to 25. Maybe it goes down to 20. Even if it goes down to 20,000, it's still flat from earlier in March this year. And so that is my sort of foray into thinking about, well, at this end of recklessness in terms of fiscal and monetary policy, we're going to get the opposite effect by raising rates than what we think. And therefore, on both scenarios, whether the Fed raises or cuts, we are in a good position as a cryptocurrency industry. And so I'll end this saying, buy the motherfucking dip. Thank you.